Hello students, I hope you're all doing well. Welcome to a very new video from QuickStudy. That's because this is the very first video which covers the GCSE Accounting syllabus. And in this video, we'll learn about the different types of business organization, and this is from topic 1, which is the accounting environment. And in this video, we are going to learn about the sole traders and partnerships, which are two different types of business organizations. And we'll also learn about the characteristics of private sector organizations and public sector organizations. Furthermore, we'll learn about the connection between stakeholders and business and how you can identify the stakeholders' use of the business's financial statements. So firstly, we need to understand what is a sole trader. It is the simplest form of business organization, and this is usually run by a single person or the owner who may choose to hire employees. And these businesses may have a name or might not, because they might run under the name of the owner themselves. And the sole trader or the owner is solely responsible for the failure or success of the business. And sole trader businesses actually have unlimited liability, which means that in case of business failure or bankruptcy, the owner's personal assets may be at risk. And one of the main reasons why small to medium-sized businesses opt for a sole tradership business is because there is little to no formal startup costs and there is very little paperwork required. And at the same time, sole trader businesses do not have to publish their financial statements or make them available to the public. So why would you want to start a sole tradership business? Of course, there are particular advantages that sole tradership business has to offer. And one of the main benefits of a sole tradership business is that it's easy to set up, since there are little to no costs required and little to no paperwork required as well. And another reason is that the sole trader can keep all the profits for themselves, since they are the single beneficiary or the owner of the business. And at the same time, they have complete control over the business. Since they are the only decision makers, they do not have to consult with someone else when they are about to make a business decision. And this also makes the decision-making process much easier and faster at the same time. And of course, at the same time, since sole tradership businesses are not obligated to publish their final accounts or financial statements, this works as an advantage. But of course, with positive sides comes negatives too. And one of the main problems with being a sole tradership business is the lack of capital, because since there is only one owner, a single person can only raise so much money, right? If there were multiple partners, they would have been able to accumulate larger sums of capital. And another problem with sole tradership business is that it has an unlimited liability, which means that in case of business bankruptcy, or when the business is not really solvent, the owner's personal assets may be seized by the financial institution to cover up for the debt. And of course, another problem with the sole trader business is that since it's a single owner business, a single person might not have all the necessary skills to run the business. So it might, or it could be wiser if there are multiple partners who are skilled in different forms of work, so that they would be able to help each other run the business better. And of course, the decision-making process, because of this very same reason, can be stressful, because there is a lack of expertise in every other field or aspect that a business organization needs. And the biggest problem, in my personal opinion, with the sole tradership business is that there is no continuity, which means that if the owner dies, the business ceases to exist. All right, now that we have talked about sole tradership businesses for quite a bit, let us look at a different form of business organization, which is a partnership business. So what is a partnership business really? In its most simplest form, this is a business organization which consists of multiple partners. And usually that number is between 2 and 20. And partnership businesses also have unlimited liability, which means that the owners are responsible to pay off their debt with using their personal assets in case the business goes bankrupt. And when it comes to a partnership business, they will usually have a deed of partnership, which is basically an agreement between the partners where they decide, it's like a legal contract. And this is usually drawn out to decide how much of the profits the partners are going to share among themselves. And this is usually drafted by an accountant or an auditor. It might be done by a lawyer too. And what a deed of partnership can do for partnership businesses is basically help resolve future conflicts between the partners themselves. And of course, when you are running a partnership business, you have to comply with particular laws. For example, in the UK, there is the Partnership Act 1890. So why would you want to start a partnership business? Of course, because it has particular benefits that has to offer. First of all, one of the main benefits is that since there are multiple owners, they'll be able to accumulate more capital together. And at the same time, another advantage with partnership businesses is that the owners will be able to share the losses amongst themselves. So very much unlike sole tradership businesses where the owner themselves are solely liable for all the business losses. And at the same time, partnership businesses will have a diverse set of skills. This is because the partners may come from different backgrounds who might have a different expertise or specialty, which can further help the business. And this can also allow them to share the responsibility of the work that they're supposed to do. In case a partner is sick, the other person can cover in place for themselves. And this is very suitable for professional practices. So when we look at there are law firms and there are accounting firms. So these businesses will actually take the form of a partnership business because it's much better suited to operate it that way. And of course, there are tax benefits as well that can come along with partnership businesses because the profits are taxed as personal income. And at the same time, very much similar to sole tradership businesses, partnership businesses are also not obligated or liable to post their final accounts or make them available to the public. But of course, there are problems with partnership businesses too. Very much like sole tradership businesses, they also have unlimited liability, which means that unable to pay off business debts due to bankruptcy may lead to seizure of the owner's personal assets. And at the same time, the problem with partnership businesses is that it's very difficult to, if a particular partner would want to leave the partnership, it would be known as dissolution, and the process of dissolution can be problematic. And there are problems with liquidation too. That's because when you are shutting down the business, you have to sell off the existing assets and settle all the liabilities, which can be difficult. And at the same time, partnership businesses also have a limitation when it comes to raising capital. Yes, I understand there are multiple partners who can contribute to raise the money that is needed for the business organization, but it would have been much better if it was a limited company because there'd be no restrictions to the number of partners that you can admit in a business. So you'd be able to raise more money. And another problem with partnership businesses is that the profits would have to be shared. Yes, I know I just talked about the advantage where the owners will be able to share the losses amongst themselves, but it's also the case that the profits are also not limited to a single owner only. The partners will have to share the profits among themselves according to the profit sharing ratio, which may have been drawn up in the deed of partnership. And of course, another problem with partnership business is the potentiality of conflict that may arise between partners. So when they are trying to make a decision, multiple partners may have multiple opinions, which can make the decision-making process much more complicated and time-consuming. So like we have already talked about it, the deed of partnership, we need to know about this in a bit more detail. So like I've already said, a deed of partnership is basically a legal agreement between partners, and it can be written or it can be verbal. It's not really legally required, but it's very much recommended that a partnership business has a deed of partnership in place. This will usually include, firstly, the capital contribution, which is how much money each partner is investing into the business. And it will also include the profit and loss sharing ratio, which basically means how much profit each partner is entitled to, and at the same time, how much loss a partner will be sharing with each other. And the deed of partnership may also contain how much a partner is entitled to a particular salary. So a lot of the times, the partner themselves may work in the business. So in that scenario, the partner will be liable to receive a salary from the business organization, and this is usually mentioned in the deed of partnership. And another important factor in the deed of partnership is the interest on capital. Interest on capital is basically how much interest a partner will receive depending upon the amount of capital that they have invested into the business. And this is an important factor too, because this actually works as a motivating factor for the partners to invest as much money as they possibly can into the business, since there's an incentive, because the higher capital contribution that each partner has, they will also receive a higher amount of return in the form of interest on capital. And Another point in the deed of partnership includes the interest on drawings. So a lot of the times a partner may want to withdraw some of their capital from the business organization, and that might be for a temporary period of time. So what that means is when a partner is withdrawing money from the business, they would have to pay a certain amount in interest for the amount of money that they have withdrawn, which is known as drawings, right? So the interest on drawings, how much interest a partner will pay on their amount drawn from the business, is also mentioned in the deed of partnership. All right, now that we have talked about how sole tradership businesses work and how partnership businesses work, we need to understand the difference between private sector organizations and public sector organizations. So firstly, we're going to start with private sector organizations. And these are businesses which are run for a profit motive and they are not run by the government. So examples may include sole tradership businesses, partnership businesses, and limited companies. And of course, these are businesses which go through an incorporation process. What that really means is that they have a legal identity. So the business has a separate legal identity from its owners, and the business is registered under the organization's name, and they are not in any way related to the owner. And in the UK, if you would want to register a private sector company, you would have to register with the Registrar of Companies, and you'd have to comply with the Companies Act 2006. And so what is the main benefit? I mean, why would you want to go through an incorporation process? One of the main benefits of incorporating your business is limited liability. What that means is that the owners will not be held personally responsible, or the owner's personal assets will be safe in case of a business failure or bankruptcy. And there's divorce of ownership as well, which means that the owners can separate themselves from the day-to-day operations of the business. And this can actually help the managers to make decisions on behalf of the owners. So the owners do not have to be physically present in their business every single day. And like I have just already said, these are private sector businesses can be incorporated, and these are usually limited liability companies. So what that means is that for these businesses, the accounts must be audited by an independent accountant or an auditor, so that they are making sure that whatever final accounts or financial statements that you are posting, they are actually accurate and they are fairly valued. And there are different types of limited liability companies. There are private limited companies, which is usually owned by a small group of people. And then there are public limited companies, and this can be owned by anyone. And public limited companies are actually listed on the stock exchange. So anybody will be able to purchase the shares of a public limited company from the stock exchange, but that's not the case with private limited companies. Private limited companies shares are sold only to families and friends, and these businesses cannot be listed in the stock exchange. All right, now we are going to talk about public sector businesses. And students, before I start with public sector businesses, I want to make sure that you do not mix up all these things together. So there are private sector businesses, which includes public limited companies and both private limited companies. And public sector businesses are a completely different criteria. So public sector businesses are owned and run by the government, and these businesses do not run with a profit motive, but with the motive for maximizing the welfare of the society. And these are organizations which are funded by the taxes that people pay to the government, right? And in the UK, there are many public services which are run by public sector organizations, which includes hospitals, libraries, education, which is provided up to 18. And like other public services in the UK, you actually have to pay for travel, which is also free in particular countries. All right, now we are going to take a look at the connection between stakeholders and a business. So who are stakeholders really? Stakeholders are individuals or groups of people or organizations who are positively or negatively affected by business activities. And there are different groups of stakeholders. Firstly, we're going to start with the business owners themselves, who are also stakeholders. So how is an owner affected by business activities? First of all, they would like to assess the overall profitability of the business. They would also want to monitor the business performance over time and evaluate how safe their investment is into the business organization. And they actually have to determine if they're actually going to receive their share of the profit. And another group of stakeholders are the managers in a business, who needs the financial information to make sure that the business performance is going as per they have planned. And the managers would also have to make the decisions based on the financial data that they have received from the business. And the employees also need the financial information in a business because they need to assess how secure their job is. Because if they are not able to look at the financials of the business that they're working for, it might create a sense of anxiety amongst the employees, because they wouldn't really know the true picture of the business performance. And at the same time, knowing about the company's financial performance allows the employees to actually ask for a raise when they know it, because if they knew that the company is not in a good position, they would not ask for a raise for their wages, right? And at the same time, the customers would need to know the financial performance of a business too, because they would need to know if the business that they're dealing with is stable or not. So they need to have some sort of security for the goods and services that they're buying from their company. A lot of the times, a customer will buy, say, a car from a dealership, and that's not the end of the relationship with the customer, because the dealership is liable to provide particular services to the customer, right? Like after-sales services, which includes servicing and other stuff for their vehicles. So a business with very bad financial performance or situation will not be able to provide good services to a customer. And the suppliers in an organization are they would also want to know the financial condition of a business, because they need to know what kind of a business they're dealing with, whether the business who is buying goods from the suppliers will be able to make payments on time. And it also actually helps the supplier to determine how much interest rate they're going to charge to the business when they're selling goods on credit. And of course, the providers of external finance also needs to know the financial performance or position of a business, because they will be lending out money to the business, and they need to evaluate the company's performance and understand if the business will be able to make timely payments to them. And finally, the final group of stakeholders that we're going to talk about is basically the government. They need the financial information of a business because they need to monitor how much the business is liable for taxes. All right, now that we have talked about the different groups of stakeholders who are affected by business activities and why they need to know about the financial performance of a business, we need to understand what are accounting concepts and why are these important. So a business will prepare their final accounts at the end of the financial year. Final accounts may include statements like the statement of financial position, also known as the balance sheet. It might have the statement of comprehensive income, also known as the income statement, and of course the statement of cash flows. And what are accounting concepts and rules basically? So these have actually evolved over time for practical and theoretical reasons. So one of the main reasons why there are accounting rules and regulations or concepts is to make sure that the documents or the final accounts are standardized, which means when you look at the final accounts of different companies throughout the different periods of time, you need to be able to compare those documents or financial statements. And this makes it much easier for the stakeholders to make decisions upon those documents. And we're only going to talk about a few of the accounting concepts in short, but we'll discuss them much more broadly in later chapters. So one of the main concepts is the business entity concept, which states that the business and the owner are two separate legal entities. And then we have the materiality concept, which means that only significant items that affects the financial statements has to be regarded or taken into account for. And then we have the consistency concept, which means that when we start using a particular method of doing our accounting work, we need to consistently follow that one particular method to make sure that the values that we have recorded are not distorted over time. And then we have the accruals concept. Accruals concept states that the revenues and the expenses for a particular year should be recognized just as they occur, not when you have received the payments for them. And then we have the money measurement concept, which states that items which can only be translated or which can only be measured in monetary value finds a place in the books of accounts. And items which do not or which cannot be measurable will not find a place in the books of accounts. And then we have the prudence concept as well. Prudence concept tells us that we should be, it's very much more likely and it's best if we were to not overstate assets or not overstate our profits. It would be much wiser if we were to understate them. Alright students, with that we have come towards the very end of this video, and to give you a short recap of what we have covered so far, we have talked about different types of business organizations, which include sole traderships and partnerships. We have also discussed the characteristics of private sector organizations and public sector organizations. Furthermore, we have talked about the connections between stakeholders and a business, and we have identified how stakeholders use the business's financial documents. And students, with that, I'd like to thank you for watching this video. And if you've liked this video, do subscribe to our channel since we post regularly on different topics and subjects that can help you ace your GCSEs. And of course, if you'd like to know more about us or our online one-on-one tutoring services, do visit our website at www.quickstudy.uk. Thank you.